Breaking news for everyone across the UK, cash may still be king for many households and small businesses, but HMRC is making it clear its days on the throne are numbered. A powerful new crackdown is now underway, targeting large withdrawals, suspicious deposits, and any financial activity that doesn't seem to add up. This isn't just about tax dodgers or criminals, it's about ordinary people too. Retirees taking out their life savings. Small shop owners handling cash payments. Families supporting loved ones with lump sums. Even those who simply prefer to use notes instead of cards. If that sounds like you, then listen carefully, because HMRC's new approach could affect how you access and use your own money. And if you're not prepared, you could face unexpected investigations, heavy fines, or worse. This is an update you simply cannot afford to miss. For decades, HMRC has kept an eye on unusual financial behavior, but cash withdrawals are now being flagged with unprecedented intensity. Why? Because in today's digital economy, almost everything we buy is traceable. Cards, bank transfers, mobile payments, they all leave a trail. Cash, on the other hand, is different. It's private. It's hard to trace. And for HMRC, that makes it suspicious. Officials argue that cash is too often linked to hidden or undeclared income, money laundering, or even criminal activity. But here's the problem: while HMRC says this is about stopping fraud, in reality, it means more and more ordinary people are being caught in the net. A simple withdrawal could now raise red flags that never existed before. One of the most worrying parts of this crackdown is that there is no single, fixed threshold that automatically sets off an investigation. Instead, HMRC looks at patterns and behavior. Withdraw several £1,000s at once, and your bank may report it. Make repeated smaller withdrawals over time, and those could also be flagged. The key is unusual behavior, and banks are now legally obligated to decide what that looks like. Even if it's your own hard-earned money, banks must file a suspicious activity report if your transactions don't fit the profile they expect. And once that report reaches HMRC, the scrutiny begins. Let's talk about small businesses, because they are right in the firing line. Retail shops, cafes, takeaways, pubs, and many in hospitality still rely heavily on cash. For them, handling physical money is part of daily life. But HMRC is zeroing in on these cash-heavy industries. Every deposit, every withdrawal, every recorded sale now needs to align perfectly with the accounts. If something doesn't match up, HMRC may assume there's undeclared income. This means business owners will face more paperwork, more pressure, and potentially more audits. Even those running legitimate businesses could be pulled into stressful investigations, simply because they deal in cash. And it's not just businesses. Ordinary people, everyday taxpayers, are also vulnerable. Imagine you've been saving up for years, and you finally withdraw a lump sum to buy a second-hand car. To you, it's simple. But to HMRC, that could look suspicious. Perhaps you gift cash to a family member. Or withdraw money for a wedding, holiday, or emergency. Again, totally normal. But unless you can prove where the cash came from, HMRC may treat it as undeclared income. Innocent taxpayers who fail to explain these transactions risk penalties, fines, or, at the very least, stressful questioning about money that was theirs to begin with. So, how exactly does HMRC keep track of what you're doing with your money? The answer lies in deep cooperation with banks and financial institutions. Banks are required by law to file suspicious activity reports. These are then fed into HMRC's powerful data analysis systems. Algorithms scan millions of transactions, looking for patterns that appear unusual. Sudden spikes in cash withdrawals, changes in spending habits, or ATM activity that doesn't fit your usual behavior, all of this can trigger a closer look. And remember, once a report is filed, it's not easily ignored. Even if you've done nothing wrong, you may still find yourself needing to explain. Failing to provide clear explanations for large or unusual cash movements can lead to severe consequences. For individuals, this could mean fines running into thousands of pounds. For businesses, it could mean not only fines but also tax reassessments, license losses, or even closure. And in extreme cases where HMRC suspects deliberate fraud or money laundering, criminal charges are possible. The key point is this: even innocent people may get caught in the dragnet. And while you may eventually clear your name, the process is often long, stressful, and costly. Now, let's be clear, not every withdrawal is suspicious. People withdraw cash for perfectly legitimate reasons all the time. Buying a car with cash is still legal. Supporting family through a lump sum gift is allowed. Emergencies can require sudden access to large amounts of money. Some people simply prefer cash as their main method of payment. The issue is not the withdrawal itself, it's whether you can prove why you made it. Documentation is the difference between smooth sailing and an HMRC investigation. So, how can you keep yourself safe? Here are practical steps every taxpayer should take. Keep receipts and invoices for every major purchase made with cash. Write down personal reasons for significant withdrawals, even if informal. Match your records, make sure deposits and withdrawals align with your accounts. Avoid unexplained lump sums. If you need to withdraw large amounts, have a clear, legitimate reason ready. Seek professional advice if you regularly handle large amounts of cash, especially if you run a business. Remember, transparency is your best defense. Now let's step back and look at the bigger picture. HMRC's crackdown on cash isn't just about tax, it's part of a much wider shift toward a cashless society. Every year, the use of physical money declines. More shops are going card only. More payments are being made through apps. And as digital payments rise, so does government oversight. Why? Because digital money is trackable. Every transaction leaves a record. For HMRC, that means fewer loopholes, fewer excuses, and more tax revenue. But for ordinary people, it means less privacy, less control, and more restrictions on how you use your own money. The freedom once associated with cash is slipping away, replaced by a financial system where every move is monitored. So, what's the takeaway from all this? The HMRC crackdown is real, and it's already affecting how banks and businesses handle cash. While the official aim is to stop tax evasion and money laundering, the reality is that everyday people are now under the microscope too. If you're someone who relies on cash, whether for personal spending, savings, or running a small business, you need to prepare. Keep your records, be ready to justify withdrawals, and don't assume that because it's your money, you'll be left alone. This is more than just a policy change. It's a signal of where the UK is heading, a future where cash is no longer the norm, and financial transparency is demanded at every level. Stay informed, stay prepared, and protect yourself. If you found this update helpful, don't forget to like this video, share it with friends and family, and subscribe for more urgent financial updates. Hit that notification bell so you never miss breaking news on pensions, taxes, and money matters that directly affect you. This is one story you'll want to stay ahead of, because when it comes to your money, being prepared is the best defense.